Welcome back, everybody, for the second video with the Mortgage Man. We are tracking the 10-year Treasury yield. Why? Because that's what affects mortgage rates. I will be talking in some stock trading terminology. If you're not up to date on that, please review video 1. That'll give you a little bit of basis on what we're talking about. The next few videos and going forward will probably be very short videos now that the terminology has been laid out. What have we seen over the past week? Here's a recap. Not much. We are moving sideways. However, let me take note, or let me bring to your attention that we have broken up over this blue line here, which was overhead resistance, and now we have sat on it once, sat on it twice. This is standard. What happens here is what was resistance now becomes support, and in that case we can expect in most cases a bullish action out of that, meaning that the market goes up. So with that being said, we were in a consolidation between these blue lines down here. We broke up and above, and now we're in a consolidation between these blue lines right here. But this is a more bullish scenario than it is a bearish scenario, meaning that we should be expecting and looking for higher prices down the road, in which case we will break above this 30.35 mark and start heading our way upwards. My ultimate target would be back to the 2008-2009 highs, which should put us somewhere between 5 and 5.25%. Right now, rates sit between 4.5 and 4.75%, depending on credit and money down and so on. All right, next is the monthly chart again. Let me show you this. Here's that overhead resistance, and here's the really large overhead resistance. I did not talk about this, I don't believe, in the last video, but I will show you this right here. You have this move back up into overhead, back down to here, back up into overhead. This is setting up with what could be an inverse, what's called an inverse head and shoulders pattern. This is a shoulder, this becomes the head. A lot of times we see it dip back down and we get what's called a right shoulder, and then it blows up through the top of this and it goes and goes and goes. There's another little mini inverse head and shoulders that happened right here. This would have been a shoulder, this would have been the head, this would have been a shoulder, and if you draw a line straight across here, you then have a break of that particular smaller head and shoulder, inverse head and shoulders. If that is correct, then we should be on our way up into here and maybe up into this area here, which is ultimately what I was telling you about. The highs of 2008, 2009 sitting right here. I really do like this as strong overhead for the time being. However, if we blow up through the top of this, look for us to get back into this area, which could take us back to 5.5 to 6% interest rates. Right now is not a bad time to be looking to buy, while interest rates are still actually pretty low. So even though it's not 3.75 or 4%, which is what a lot of people were looking at just probably a year ago or so, it's still a good time because it looks like rates want to go higher. If it breaks up and over this area right here, the next bigger area is this 37.5. So there's your quick video for the week. We'll let it run another week since the 10-year and markets tend to move really slow when it comes to interest rates. They can move much faster in a regular stock market, like an Apple or something to that effect. But with rates, usually it's a bit slower, so it takes it a while to get going. However, what you see here is a major moment. We break up and over this, and it looks like we are on our way to those higher levels. So if you have customers that are curious, send them to this video. If you yourself are curious, stay in touch with me right here at The Mortgage Man on Facebook, or you'll see the information popping up. You can reach me there by email. You can call me. I'm right here in Rapid City at Gateway Mortgage. Talk to you guys in the next video. Bye.